stage, we have Chris Rolls, Managing Partner at Pi Lab Capital, talking about why the world's best investors are allocating more capital to private equity.
Hello, and a very good morning. I'm going to start with a quick audience survey. So if you're down the back having a chat, if I can just get you to look in this direction, down the back there. Same over the back here as well. I want to start with a quick audience survey because today we're going to be talking about investor returns. And I believe we're all here for the same reason, and that is to work out how we improve our investor returns. And predominantly today I'm going to be talking about the allocation of capital and why the world's best investors are allocating more and more capital to private equity. But I can start with a quick show of hands. Who in the room, and I want you to raise your hands nice and high, who in the room currently invests in publicly listed shares? Now, it'll probably be almost everyone, so raise your hand if that applies to you. Don't be shy, put your hand up. Yep, okay. Who here in the room currently invests in property, be it residential, commercial, industrial? Raise your hands nice and high. Okay, once again, the bulk of the room. Who here currently invests in private equity, be it directly in companies or in funds? Raise your hands. Okay, a lot lower number of people. And the question is why? And like you, I'm an investor, and I've spent probably the last 15 years trying to answer that question. Why is it that the world's best investors invest so much of their capital in private equity, yet most retail or sophisticated or smaller investors typically don't? And what I'm going to share with you is the results of some of that research over the last 15 years. Now, I wasn't always an investor. In fact, I've built and sold 4 businesses. I started as an entrepreneur. The last business I had was a business managing property. We managed about $2.5 billion of residential property across Queensland, making us the largest property manager in that state. I sold that business about 6 or 7 years ago. And it was about probably 5 or 6 years before that I started my journey into really understanding private equity and private equity returns. And one of the things that I did on that journey is I studied private equity and venture capital investing all over the world. I studied venture capital investing at the University of California. I studied private equity investing at Harvard Business School. I studied value investing at Columbia Business School in classes originally taught by Warren Buffett. I've done all of the journeys to Omaha for his annual general meeting. I've spent the best part of the last 10 years interviewing some of the world's best investors in private equity. And I'm going to share with you what I learned right now. Before we do, I want to just make clear for those that may not be completely across it, what is private equity? Private equity is effectively investing money in private businesses in return for equity. Okay, so a business needs to raise some capital. They can usually do that through either debt or equity, and private equity is the investing of that capital in those businesses. Now, interestingly, it comes in all sorts of forms. A lot of people think that venture capital is different to private equity. Private equity is a broad category of which venture capital is simply investing in earlier stage, often high growth technology businesses. You may have heard people talk about things like expansion growth capital, buyout capital, rescue or turnaround capital, or sometimes terms like special situations. All of those often fall under private equity investing. How does a private equity fund work? The typical fund or the traditional fund works a little bit like this. A fund manager establishes a fund, they raise some capital into it, and they source and invest that capital in businesses. And they do that over a period of maybe 2 to 4, 2 to 5 years. They then manage and improve those portfolio companies. And then after a period of sort of 7 or so years, they start to exit those businesses over a period of 2 or 3 years and return that capital to investors. When you invest in private equity, your capital is typically tied up for a long period of time, which is one of the things that makes it out of reach of a lot of investors. But when you look at the returns that are generated from this asset class, it's almost indisputable that it returns better from a risk-weighted return basis than almost all other asset classes. And I'm going to share with you some of that research. Let me first, though, tell you about what the world's best investors do. Some of you may be familiar with this guy. His name is David Swensen. Sadly, he passed away last year. David Swensen was the Chief Investment Officer of the Yale Endowment Fund. And for those that aren't familiar with endowment funds, most universities across the United States have very large endowment funds. As an example, Yale and Harvard universities both have over $50 billion of capital. It's often said that Harvard is actually a massive hedge fund masquerading as a teaching institution. But what's interesting is that the size of these endowment funds, they're able to invest for the very, very long term. And David Swensen really pioneered, changed the industry of endowment fund investing, and that was through his allocation of capital. And one of the things he did when he took control of the Yale Endowment Fund in 1985 is he changed the allocation of capital over a period of 30 years. And when he passed away in 2021, as still the Chief Investment Officer of the Yale Endowment Fund, this was how the capital was allocated. And if you have a look at this line here, venture capital, 23.5% of the capital, and leveraged buyouts, which is often a US term used for private equity, then you'll see 40% of their total capital was allocated to private equity investing. Now, I would hazard a guess there's probably nobody in this room who has 40% of all of their capital allocated to private equity. There are no superannuation funds in Australia that have 40% of all their capital allocated to private equity. And the question is why? Of course, Yale is not the only example of that. In fact, I'll just show you this scenario here. Interestingly, when he took over the Yale Endowment Fund, over 50% of their capital was allocated to US equities. And over a period of, say, 30 years, that dwindled down to its current allocation to US equities of just 2% today. And the reason is because of return. Of course, Yale is not alone. The University of Virginia, if you look at any of these organisations, you'll see big allocations, 28.2%. That's Harvard University. They're at 34% allocation of private equity. Or even Warren Buffett, the world's most famous investor, a guy who, of course, is renowned for public investing in things like Coca-Cola and Apple and American Express. If you look at his portfolio of companies, he actually has 47 investments currently in US equities and 70 in private companies which become or have become over time subsidiaries of Berkshire Hathaway. And that 70 companies accounts for almost a third of the Berkshire Hathaway portfolio. If you look at Australia, the Australian Futures Fund, 17.5% allocated to private equity, but only 8.5% allocated to ASX-listed stocks. Once again, the question is why? And if you look at how that has changed over multiple years, the Australian Futures Fund in 2009 had just 2.3% of their capital allocated to private equity. Today, as I said, it sits at 17.5%. Their allocation to domestic equities has gone the other way. It's declined from 22% down to 8.5%. Yet in this room, there are far more people investing in public equities than private equity. And of course, you see headlines like this regularly. Australian Super to double their private equity investment, and super funds as a whole in Australia tipped to roughly double or allocate an extra $100 billion to the asset class over the next 5 years. So the question is why? And the answer is simple. The returns are better. And of course, it's all very well for me to say that, but it's backed up by numerous studies. Study after study after study show that the returns generated by private equity are better. And here is just one, and I'll share a couple of them with you. But this gives you a bit of an idea. This study was done by Prequin. This here is the 20-year return of a global index of private equity firms versus the MSCI World Index. The MSCI World Index is an index of publicly traded companies representing about 85% of stocks in 23 developed countries around the world. And over a 20-year period, the average private equity firm more than doubled the returns of the average portfolio of stocks. If you take a top index, a top 25 quartile, so a private equity, this is the average returns of a private equity firm in that top quartile. Over a 15-year period, you get a similar thing, almost double the return. Over a 10-year period, you get a similar thing. Not quite, but getting close to double the return. If you look at how private equity returns compare to other asset classes, particularly real estate, you notice a very, very similar thing. This is vintages of private equity firms over the last 10 years, and you can see the top quartile, roughly double the top quartile of real estate funds. The median 50% of funds in private equity, once again, almost doubling returns generated by real estate. If you're looking at Australia, the Australian private equity landscape looks a little bit like this. $90 billion of assets under management, relatively small compared to Europe and the US. Last year, the industry raised $9.1 billion in funds, and the median This is the median return of private equity funds in Australia, returned 17.8% over the last 10 years. So they are funds that had a vintage from 10 years ago, 2012, up until today. That's the median return of private equity investment funds in Australia. How do we compare on the world stage? Actually pretty good. This is this chart here demonstrates the size of a market. So this is the size of the private equity market in Europe, and they've averaged returns. They have median returns of around the 15% mark. In the US, they're slightly higher at about 16.5%. In Australia, we're small, but at 17.8%, fractionally behind Asia, which is also a very big market as well. Of course, one of the problems with any presentation like this is there's an element of bias, and I acknowledge that. I'm a private equity investor, I run a private equity fund, and I have more than 40% of my personal portfolios invested in private equity funds, both my own and other funds. But one of the things that's interesting about bias is that in a lot of industries, it's hard to prove that bias. You talk to a stockbroker, they'll give you all the research surveys as to why the share market outperforms property. You talk to a property developer, they'll give you all the reasons why property outperforms the share market. One of the great things about private equity is you can get factual data from the myriads of institutions, endowment funds, superannuation funds who have to publish audited returns of their various asset allocation classes. And that is data you cannot argue with. And here is just an example of one such report. This one, I think, was from the University of Virginia. But if you go to any of the major superannuation funds, the Australian Sovereign Wealth Fund, you'll be able to find data that looks like this. In this case, the allocation of private equity was 28.2%. Their allocation to public equities was 24.5%. But if you look at the returns over 3, 5, 10, and 20 years, the returns of private equity in all of these charts you will see across all of these institutions will outperform the others. And I think that is the best evidence of the fact that private equity outperforms consistently. And as you can see here, take a scenario, take a 10-year scenario, private equity 21% versus their public equity portfolio, which returned 11%. Over a 5-year, 28 versus 8.5. And you see that consistently time and time again. And so the question is, well, what happens as we're moving into an uncertain economic time? Is a prospect of a recession something that's going to result in worse returns or better returns for private equity? Well, interestingly, during downturns, these are the returns of funds that were started during downturns. So this is immediately after, during and after the dot-com bubble. This is immediately during and after the global financial crisis. They typically outperform as well. And one of the reasons behind that is that private equity returns don't suffer from overselling or negative market sentiment. One of the things that happens as any economy goes into a downturn is that businesses start to perform poorly or worse than they have previously. And as a result, their valuations should decline. But what happens in the public market is that the public sentiment overestimates the doom and gloom, and they tend to oversell. And as a result, you end up with scenarios like this. This was during the dot-com bubble, and this is the valuations of private equity portfolios versus public equity portfolios. They typically decline by less and they recover faster. And the same thing has applied here after the GFC. The same thing. The private equity portfolios decline by less and tend to recover faster. And there's some very good reasons for that. So why does private equity outperform? The simplest explanation is given by this person, and I think the volume is up for this. Most of you will be familiar with Charlie Munger. Can you turn that volume up? You turn the volume up? Okay. Fish where the fish are. A really famous quote by one of the world's greatest investors. Fish where the fish are and you'll find better investments. And the facts are there are more fish in the private world than there are in the public world. In fact, the number of public companies listed on the stock exchanges around the world is declining. And this is the number of domestic companies listed on US stock exchanges. And as you can see, it's declined over the last 20 years from a high of around 2020 to almost, but not quite, half what it was back then. The number of public companies is declining, which means for investors that allocate most of their capital to the public markets, they have less and less choice of the types of companies they need to invest in. And these figures are actually happening around the world. Take the Australian Stock Exchange at the moment. Currently about 2,300 companies listed on the Australian Stock Exchange, has remained absolutely stagnant for over 10 years. Okay? The number of private companies that are raising capital, however, is increasing. Over the last 20 years, the number of private equity-owned companies has increased from 1,768 to 9,473. That's a five-fold increase. So while the number of public companies listed on the stock exchange is declining, the number of private companies that are raising capital is rapidly growing. Fish where the fish are. Simply, there are more companies to invest in, which means you can make better investment decisions. The result is, of course, that companies are staying private longer, which gives public market investors less choice on where to invest their capital. And I always look back at some of the tech examples. You take the Apple versus Facebook scenario. Once upon a time, companies had to become public, and the reason they had to become public is they wanted to raise capital or provide liquidity for their shareholders. And that is no longer the case. Private companies can raise capital and to some extent provide liquidity to their shareholders, whereas once upon a time they couldn't. You take a scenario like Apple. They listed in 1980 at a market cap, I think from memory, of about $1.7 billion. They raised $100 million at that listing, which at the time was the largest capital raise of an IPO since Ford some 30 years earlier. And so if you look at the size of Apple, the bulk of Apple's wealth has gone to public investors. From 1980 to today, at a $2 trillion market cap or whatever it's sitting at the moment, the bulk of that wealth has gone into the pockets of public investors. But you have a look at what happens today with companies like Facebook, who listed at a $100 billion market cap. The first $100 billion of value created by Facebook went to private investors. Same with Atlassian, same with Stripe, same with all of those big IPOs. All of the initial value goes to private market investors. So what are the advantages of investing in private market companies? First of all, they're cheaper to buy. For all other things taken equally, if you take one company that is private and another that is public, the price you pay to invest in that private company is less than it is in the public company. And the reason behind that is what's called the Liquidity Premium. When you invest in a public company, you can get in today, you can get out tomorrow. You can get in now, you can get out in 5 minutes later. In a private company, you can't. You invest today, it's very hard to get your money out. And as a result of that illiquidity, you pay a premium for investing in exactly the same company that generates exactly the same profits if it's on the public markets. The other thing, of course, is that private companies are not subject to short-term investor demands. One of the biggest issues of public listed companies is this cycle of quarterly reporting, quarterly earnings forecasts. And if they miss those, public companies struggle badly in the public markets. Private companies can invest for the long term, meaning they can make long-term decisions that aren't in the immediate best interests of investors who are looking to get out of the company tomorrow. They can actually invest for the future. The CEO and executive teams in private companies are not subject to the public scrutiny of their incentive packages, meaning that they can be incentivized for the long term in a way that results in longer tenure. Private companies are backed by investors who can't flee during an economic downturn. And as a result, they're more likely to provide capital to that company if it gets into trouble or during an economic downturn, which makes them less likely to fail. Shareholders are actively involved in creating value in private companies, whereas the bulk of shareholders in public companies are not actively involved in creating value for the public companies. Private companies have better access to capital during tough times, resulting in big increases in market share. And this is one of the reasons why private companies outperform during economic downturns. Picture a scenario over the next 2, 3, 4 years if we go into recession, which is relatively likely to happen. All of the recessions and depressions of the last 100 years have happened after periods of high inflation. In that scenario, what happens to a public company is the share price will be depressed, reducing their ability to raise capital in a public market. However, private equity-backed companies almost always have access to further capital if it has good potential for return. Meaning that when the price of companies across the board declines, they are more able to snap up competitors, take advantage of new opportunities and grow their market share, which is one of the reasons why private equity does so well in a downturn. And finally, private companies are able to keep market secrets secret. There is so much value to be had by not sharing everything that you do as a company with the rest of the world, and allows them to take advantage of opportunities that public companies can't. And there's some of the reasons why investing in private companies makes sense. So the big question is, why doesn't everyone do it? The data is irrefutable. The returns are better, but why doesn't everybody do it? And the answer is somewhat strange. First of all, it's against the law for some investors to invest in private equity. You have to be a sophisticated investor in almost all cases. I run a private equity fund. We don't take capital from retail investors. And that's prominently because of the bureaucracy and red tape put in our way by various governments. And this is not something unique to Australia, it happens all over the world. So unless you're a sophisticated investor, meaning you have $2.5 million of assets, or you've earned $250,000 in salary in each of the last 2 years, you're not able to invest in most private equity funds. The other reason is illiquidity. One of the reasons why wealthy people, institutions, high net worth individuals and family offices invest in private equity is because they don't need their capital back the next day. They have capital to live on, which strangely allows the rich to be richer and results in retail investors missing out on potential returns. Illiquidity is one of the biggest reasons investors are unable to invest in private equity. When you make an investment in private equity, while the returns are better, you need to be comfortable with the fact that your capital is going to be tied up for somewhere between 8 and 12 years, and that's a long time. For people creating intergenerational wealth, it's a drop in the ocean. And the final reason, and probably the most significant reason, is that typically private equity firms have very high minimum investment thresholds. Go back 10, 15 years, those thresholds were sitting at sort of $5, $10 million minimum. And lots of funds have minimums of $50 or even $100 million to invest in, clearly out of the realms of most people. Today, however, there is a significant change in the market. And that significant change is commonly referred to as a democratization of private equity. There are now more opportunities for investors, sophisticated investors, but smaller investors to invest in private equity than there has ever been in the past. And in fact, there is a significant push from a government perspective to change some of the sophisticated investor rules because there is a wide acknowledgement that many Australians are unable to invest in private equity. Those minimums have come down significantly, and particularly for the smaller funds. And one of the interesting things about funds management in general, regardless of whether it's private equity or mutual funds or whatever it happens to be, is that small funds have shown historically that they outperform big ones. And that's simply because they fish where the fish are. I'll give you an example. Our latest fund is a fund currently returning a bit over 20% per annum to our investors. We invest in small and medium recurring revenue businesses that have at least $1 million of EBITDA. We write sort of check sizes of $5 to $10 million. There are 600,000 businesses in Australia that have less than 200 employees that are in our potential pool of acquisitions. If we're running a $10 billion fund, according to the Australian Bureau of Statistics, and it's an extraordinary figure, there are a bit over 4,000 businesses in Australia that have more than 200 employees. Okay, so if you're running a $5 billion fund or a $10 billion fund, there simply aren't that many opportunities for you. You are stuck with the same dilemma that public market investors have, and that is limited choice. There's not as many fish. So the smaller funds typically outperform the bigger ones. And one of the great things about smaller funds is the investment minimums are smaller. Funds like ours will go as low as $500,000 and for selected investors down to around $250,000 depending on their background. And our preference is for investors that have previously run businesses because they add value in other ways other than just their capital. So that there is a bit of an overview on why the world's best investors are allocating more capital to private equity firms than at any time in the past. If you'd like to have a chat with us at PiLab about what we do, more than happy to have a chat. I'll be hanging around for the rest of the day. Hope you enjoy the rest of the day and learn something at the Wholesale Investor Expo. Thank you.